All right, so we've talked about an awful lot related to stock for a company. We've talked about shares that have been authorized. We've talked about shares that have been issued. And then we talked about shares that were outstanding. But when we were talking about shares that were issued and then shares that are outstanding, we said that those numbers are generally going to be a little bit different. And the example that I gave you was 100,000 shares authorized, 60,000 issued, and 55,000 outstanding. And we said that maybe the company, decides that they want to buy back 5,000 shares of their own stock. And when that happens, and it does happen, we call this treasury stock. Treasury stock is stock that a corporation has issued and then reacquired. So it's no longer outstanding. It went from being outstanding stock to being treasury stock. So it says a corporation may reacquire, purchase its own stock for a variety of reasons, to provide shares for resale to employees, particularly if the employee is going to get a good deal on it, to reissue as bonuses to employees. Boy, this is a big one right here. And then also to support the market price of the stock. Because, if you own stock in a company and you decide that you want to sell that stock and you do sell it, quite honestly, you have no idea who purchased that stock. It could be your next door neighbor. It could be someone halfway around the world, or it could be the company itself. Okay. But when stock is purchased, that has an upward trend. It pushes the stock price up on every sale. So imagine a stock that's $20 and it drops to 19 and somebody goes in and buys a whole bunch of it, that stops the fall and actually maybe nudges it up some. So this is a real thing here. Says that the cost method is normally used for recording the purchase by the company and the resale of treasury stock. So before we get into what the cost method is, let's understand what's going on here. We know that treasury stock is stock that has been repurchased by the company, but then later on they're going to probably resell that to somebody. Maybe it's a resale to employees, maybe it's a resale on the open market. So using the cost method, treasury stock is going to be debited for the cost purchase price of the stock. That makes sense because we're going to use what to buy it? Cash. So treasury stock would be our debit and then cash would be our credit. However, when the stock is resold, treasury stock is credited for its cost. Credited because we no longer have it. It went down. Any difference between the cost and the selling price is debited or credited to paid-in capital from the sale of treasury stock. So what we're saying here, essentially, is that companies are not allowed to recognize gains or losses on the resale of treasury stock. So instead, the account that's debited is paid in capital from the sale of treasury stock. Well, I want you to understand, when we talk about paid in capital right here, paid in capital is a source of equity. So it says, as a result, stockholders' equity either increases or decreases. So let's use this as an example, and then we'll actually look at some examples. But let's say that we repurchased some treasury stock for $50 a share, and we did that for 10 shares, okay? And then we sold that later on for $55 per share. Well, we're gonna, we debited treasury stock for the $50 per share when we bought it. Then we're going to credit it for $50 per share when we sell it. That $5 extra is not a gain or income to the company. It goes into paid-in capital, and we said 10 shares. Let's get the calculator. We sold it for 55 minus the 50 we had in it is 5 times the 10 shares. We're using really small numbers here. $50. That would be going into the paid-in capital from the sale of Treasury stock. Okay, and that is going to, in this particular example, is going to increase owner's equity. If we had sold it for 45, it would still be a $50 difference. 50 minus 45 is 5 times 10, and that would decrease owner's equity. So here we have a little bit of an illustration. It says, assume that a corporation has the following paid-in capital on January 1. Common stock, $25 par, 20,000 shares authorized and issued. So 25 times 200,000 equals 500,000. And then excess of issue price over par. I'm not sure we have this anywhere, but this would just be called paid-in capital in excess of par is 150,000. So our total stock value here is $650,000. So we've got three things that are occurring here. On February the 13th, they're going to purchase 1,000 shares of its own common stock for $45 per share. On April the 29th, they're going to sell 600 of those shares for $60 a piece. Then on October the 4th, they're going to sell the remaining shares for $40 a piece. So notice in this transaction, April 29th, we're selling the Treasury stock for $15 more than what we paid. We cannot call that a gain. October the 4th, we sold the remaining 400 for $5 less. This is not a loss. Let's see how we do this. The October 4th entry decreases paid-in capital by $2,000. Let's take a look at that. This one right here. Okay. So let's bring the calculator over here. I want to go back to this slide real quickly. And we've got 600 shares that we sold for $60. Now what I want to do is I want to take the sales price of 60 and I want to subtract out the amount that we paid to give us 15. That's the spread. We multiply that by the 600 shares, and that increases paid-in capital from the sale of Treasury stock by $9,000. Okay. This transaction, we're going to take the $45 that we paid minus the proceeds, and that's going to give us $5 times, you know what, let's do this. Let's take the $40 that we sold it for minus 45. That's going to give us -5 to show that we sold it for less. Then let's multiply that by the number of shares, 400. This is going to decrease paid-in capital from the sale of Treasury stock. That's an account by $2,000. Okay. So now let's go to the next slide. So the October 4th entry decreases paid-in capital by $2,000. Because paid-in capital from the sale of Treasury stock previously had a credit balance of $9,000, which is what we want, paid-in capital, we want that to have a credit balance. What we would do is we would debit the entire $2,000 to paid-in capital, and the net increase in paid-in capital for the investors, or the increase in stockholders' equity, is going to be the 9,000 minus the 2,000. So those two transactions increased owners' equity by $7,000. We do want to make a little bit of a notation here to try not to confuse the issue. if this situation had been a little bit reversed, let's just say that instead of selling those shares for $60 in the April 29th transaction, I believe it was, we had sold them for more than 45, but not much more. It says if the credit balance and paid in capital from the sale of Treasury stock, let's see here, on October 4th had been 1,500. I think they've got their dates wrong. Let's go back. Yeah, they do. So let's reword this. If the credit balance in paid in capital from the sale of Treasury stock on April 29th had been $1,500 instead of $9,000, retained earnings would have been debited for $500. We started off with $1,500, $1,500 being credited to paid in capital from the sale of Treasury stock, but then we lost 2,000 of that, so we're in the negative. So we would then debit retained earnings for the difference, $500. All right, and hopefully we don't have this happen, but you know, if it does, it does. In this case, owner's equity would have gone down overall by 500 instead of increasing by 7,000. We have to do it that way, as it says, because paid in capital from the sale of Treasury stock may not have a debit balance. All right, and we are going to have some exercise, some what I call handout videos on this, so that you can become better acquainted with it. Do notice that no dividends, cash or stock, are ever paid on the shares of Treasury stock. So a company buys back some of their shares of stock, say 1,000 shares. If they pay dividends on those stocks, they would basically be paying dividend revenue to themselves and from themselves. And he says you cannot do that. All right, one more topic here that I want to discuss with you. We will have a little bit. If you're in one of my classes, you probably have a little bit of your homework assignment on this, is the idea of earnings per share. And it says earnings per common share, sometimes called basic earnings per share, and that's the only kind we'll ever look at in this class, is the earnings per share of common stock outstanding during the period. This basically it's a good way of letting investors know what amount of capital is available to common stockholders. All right. It says it's also a requirement for publicly traded companies. Corporations whose stock is traded in the public market must report earnings per share on their income statements. And we have a very, very basic calculation here. Earnings per share is computed as follows. We take net income for the period. We subtract out the amount of preferred dividends that are owed. And then we're going to, in our denominator, we're going to divide by the weighted number of shares outstanding for common stock. So if we do that, if we say that we have, $1 million in net income, but then we're going to subtract from that preferred dividends of, say, I don't know, $80,000, that leaves us with $920,000. Then let's say that we have a weighted average of, throughout the year, common stock of 460,000 shares. We end up with an earnings per share for common stock of $2 per share. And that's really all there is to that. All right, that concludes the PowerPoint videos for Chapter 12.